Artificial intelligence is steadily transitioning from experimentation to real-world deployment as we move toward 2026. But that transition has also created confusion for investors. Many firms benefit from short-term enthusiasm without demonstrating sustainable fundamentals. This makes disciplined analysis increasingly important. Trading around the $12 range and classified as a small-cap stock. SoundHound often attracts attention because it offers direct exposure to conversational and voice-based artificial intelligence rather than indirect or peripheral. SoundHound's core business centers on voice AI, software that enables machines to understand and respond to natural language in real time. Its technology is deployed across several industries, including automotive infotainment systems, restaurant ordering platforms, and enterprise voice applications, embedding its AI into third-party products and services. This business model positions the company differently from large platform-based AI providers. But it also introduces a distinct set of execution challenges. From a fundamental standpoint, SoundHound has reported year-over-year revenue growth in recent quarters, according to its publicly available earnings reports and regulatory filings. This growth suggests increasing adoption of its technology across commercial use cases. The company remains unprofitable and continues to report net losses. As a result, operational execution, cost control, and capital allocation remain critical variables that investors must monitor closely. Like many early-stage AI companies, SoundHound maintains cash reserves but also operates with financial constraints typical of small-cap growth companies. And customer acquisition requires funding, which introduces the possibility of future dilution if additional capital is raised. But it is a structural risk that long-term investors must acknowledge when evaluating emerging AI firms. The long-term AI thesis for SoundHound is grounded in the growing adoption of embedded voice interfaces. As AI becomes more integrated into vehicles, smart devices, and enterprise workflows, real-time speech recognition and conversational intelligence may become standard features rather than optional add-ons. SoundHound's focus on domain-specific voice AI allows it to tailor solutions for particular industries. This specialization could represent a competitive advantage if demand continues to grow and if the company is going to maintain technological relevance. However, this opportunity exists alongside substantial risks, broader ecosystems, and existing enterprise relationships. These firms can invest aggressively in voice AI, sometimes treating it as a supporting feature rather than a standalone revenue driver. SoundHound must therefore compete not only on technology, but also on pricing, reliability, and long-term support. Revenue growth may not always be linear, and quarterly results can be affected by delayed deployments or shifting customer priorities, meaning broader economic conditions can influence adoption rates regardless of product quality. Regulatory developments related to artificial intelligence and data usage could also impact how voice AI is deployed across different regions and industries. Changes in market sentiment toward AI and broader equity market volatility expand deployments, manage costs, and eventually convert revenue growth into sustainable cash flow. None of these outcomes are guaranteed, even in a favorable AI adoption environment. It is important to emphasize that this discussion is intended strictly for educational purposes. A licensed financial professional before making investment decisions. Smaller AI-focused companies like SoundHound can offer exposure to meaningful technological trends. But they also carry elevated risk relative to larger, more established firms. In summary, SoundHound AI illustrates both the potential and the uncertainty inherent in small-cap AI investments. The company operates in a growing segment of the AI market with real-world applications and demonstrated revenue growth. At the same time, it faces competitive, financial, and execution-related challenges that should not be overlooked. Evaluating such a stock requires a balanced, risk-aware perspective grounded in fundamentals rather than hype. For long-term investors, the key question is not whether AI will grow, but which companies can translate that growth into durable, sustainable businesses over time.